And this is a bit of a reprise of the presentation that we gave at the national conference back in September. So looking forward to bringing this information to those of you who weren't able to attend then. A couple of things, just first to let you know who I am and where I come from. The Nonprofits Assistance Fund is a community development financial institution located in the Twin Cities and serves all of Minnesota and surrounding communities. And our goal, our actual mission, is the financial health of other nonprofits. And we do that by providing lots of resources, including our website, which is available to anyone and very highly used. We do trainings and technical assistance. We also actually provide loan funds to nonprofits in our geographic service area. So we have a lot of expertise that we like to bring to financial topics and really enjoy learning from different nonprofits around the state and around the country, and trying to then funnel that back to other nonprofits so that we're sort of a conduit for funneling good information about financial management topics, and like the one today. And just to talk a little bit about what we're hoping to do with today's webinar, promoting transparency and managing risk. The goals of the session are really, I'll put these four up here for you to look at, and then just to let you know that part of what we want to do is realize that there are different scales that organizations are at in their development. Some of you may be solo staff at very small organizations. Some of you may be in organizations that have 10 or 20 employees and have grown through the years to, manage multiple programs and several different funding streams. So we know that we have a real mix of folks on the call. And I'll tell you, one of the things that I sort of hold to as a principle when presenting financial information and management information for nonprofits is that we never try to dumb information down, but always know that we're always on a continuous process of educating ourselves up. So I will very much appreciate getting questions at whatever scale and whatever organizational development stage you're at. I'm looking forward to questions that will help focus some of this material specifically to your needs. But the four things that we're going to try to cover today in our hour of presentation, and then hopefully roughly 30 minutes of questions and answer afterwards, are just looking at basic, what are the characteristics of a financially healthy nonprofit. I'm going to focus on a couple of things, and we'll talk about those soon, but looking at financial policies and procedures, internal controls, and then also spend a little time talking about what makes us unique as nonprofit organizations, and that is, of course, the fact that we, along with our mission-driven sort of purpose in the world, we also have restricted funds that come to us that donors actually can restrict how we use and when we use funds that come in to our organizations. Very different from the for-profit world, and one of the things that makes us unique, but also one of the things that actually makes our accounting and financial management so much more complex. And then finally, we'll talk a little bit about different uses of external review. And we'll talk about audits and compilations and reviews and things that accountants do, but we'll also talk more generally about some other ways that we can provide good oversight for our organizations outside of those CPA firm, CPA sort of related services. So what is financial health? Good question for all of us. I think usually in organizations, especially nonprofits, we always tend to look to the bottom line and think that if there's a positive number at the bottom, we're healthy financially. Well, we happen to think we have a little broader understanding of what financial health really looks like for nonprofits. And here are some of the things that are key to us. One, we sort of assume, well, just at least for this presentation, we're going to assume that the first three pieces of this, or the first three items listed here, are actually intact. We're not addressing those today, not in any real specific way at least. But basically, having a good mission and vision and the finances that are all aligned really are what fuel nonprofits. I've never, well, at least let's put it this way. I have yet to meet anyone who started a nonprofit because they were looking to learn how to better become a financial manager. Generally, people start nonprofits because they're looking to do something in the world that's not getting done. There's some need, some vision they have of how to make a change in the world. And that's why nonprofits sort of generate, not spontaneously, but out of people's goodwill and hopes for the world. Now, another thing that makes a nonprofit that comes into being with those sort of principles in mind and some mission focus, something that helps them then become a financially healthy nonprofit, is having sort of clear roles and responsibilities laid out, because often those organizations start on a volunteer basis, maybe usually a few people who get together and become the founding board members and the incorporators of a nonprofit. From there, they start to do good work and maybe then finally receive some outside funding. That generates a whole new set of challenges and questions and management issues that need to be solved. Once an organization gets up and running, we need to have an effective planning process to know where we're going in the future, how we're going to get this organization to get from where we are now to where we know we need to be, just to address the needs we've identified. The two things that I will talk about mostly today are the last two issues on this slide, which are coming up with good financial management practices that fit your organization and where it is in its life cycle, and then also looking at policies and procedures and different ways that an organization can make sure that it is accountable both internally and externally, which is a key thing in keeping our donors and the public and our clients to keep their confidence in what we're doing, and because our integrity really will carry us a long way when we're trying to do good work in the public sector like this. So to start with the financial policies, procedures, and controls, we'll go through these in a little bit of an order that's similar to what we covered back in September. But first, this question, what risks do nonprofits face? And just to give you a little time to think about that on your own and churn up some of the ideas you might have, I think the biggest one, the one that sort of gains the most national attention and certainly local attention, it's newsworthy always, is fraud. And we think about the risk of fraud in nonprofits. We've all heard the stories, sometimes from very, very large nonprofits. In the last 10 years, there's been at least one or two examples where nonprofits as a sector have really taken a hit just based on some of the improprieties of larger nonprofits, or at least the staff of some larger nonprofits, absconding with funds, using funds for personal gain, those sorts of things. That kind of fraud does happen, but it's not really prevalent. Generally, the kinds of fraud that are more prevalent are sort of nickel and dime, smaller sorts of misuse of funds or assets of an organization. The one thing I'll say about that is that talking about fraud should not be seen as a scare tactic or something that your board needs to be alarmed about, but I think it's a good place for boards to start and staffs to start to realize that everybody's in this together. Nobody should be suspicious of one another. In fact, that's not the point at all of talking about fraud. But at least to put it out on the table, it's something that could happen, and then how can we sort of set our systems and our management policies and our overall philosophy as an organization in place so that fraud is acknowledged but addressed in a confident way that puts us all back on the sort of same footing that we can trust what we're doing here and that the public will trust us as well. Here are some things that are sort of common to fraud being perpetrated in an organization. Believe it or not, most fraud cases are perpetrated by people who were highly trusted individuals within an organization. And at first it seems shocking that the people we trust most would be the ones who commit fraud, but then you think about it and it's like, oh, of course, the people we trust most are generally the people that we oversee the least. We tend to not put in place things that help us oversee someone's work or check in on somebody's work when we trust them implicitly. And that, of course, is the key to a fraud taking place, is opportunity. So any employee that's given too much sway over a single transaction cycle, and we'll talk more about that a little later, employees that are not closely supervised, and sometimes that's the opportunity that they need to actually perpetrate a fraud. Now, the way that we counteract that starts with sort of the tone at the top. You'll often hear that coming out of the auditing world and business management and business ethics, the tone at the top matters quite a lot. So our board and our executive directors tend to be the place where we have policies that are put in place and an outlook and a way of doing business, personal integrity and organizational integrity. Those things matter. So from the top down, that tone will often permeate an organization. Now, it doesn't mean that having somebody who has integrity at the top can prevent someone who is a subordinate from perpetrating fraud, but it helps to know that those folks would not feel that they were encouraged or in any way overlooked as far as being able to perpetrate fraud. So policies, tone at the top. The other thing, believe it or not, that will sometimes, high expectations is on there. It's sort of a double meaning. One, high expectations from the staff and board that we run an integral shop, that our policies, our actions, our procedures are all put in order so that we are operating with integrity. That works in a positive way. Too high of expectations of staff, meaning asking people to do things that are impossible to them as far as their place in the organization, their skill level, those sorts of things can actually break down someone's confidence and sort of put in place an attitude that they might have that would encourage them to actually begin thinking about fraud. So now, how do we assess the risk for ourselves? And this can just be a formal or informal task depending on how you are set up as an organization, what you're, who's in play here. Do you have a board but only one staff person? Do you have a large organization? But basically, we go through the organization both financially and consider what could be lost. So financial assets, actual equipment and furniture. But the other things that we often don't think about when we're thinking about fraud are more intangible. Fraud perpetrated in an agency by one person may actually cause someone who is an actual very much valued employee to leave the organization, both because they feel ashamed or feel at risk in the organization themselves, or just looking for better opportunities. So there's always a chance that the fraud that takes place could affect the human resources that we have quite a lot as well. Of course, then the sort of major thing that can happen from fraud is a real hit to the organization's reputation, credibility, and with that comes funding or the lack of, and the impact that it can have on our mission. So it is important that we take responsibility for fraud and set out a good plan to manage it. So it leaves us with that last question, who is responsible for the risk management in your organization? Now here's just a quick look at how we've sort of envisioned the hierarchy that is in place for financial controls. And obviously we talked about the tone at the top, so the mission, the values, the culture of the organization. The way that it was getting put in place, certainly the board has the overall responsibility and authority for the way the organization is run and sets the policies at that level. And out of those policies, then we put together procedures and systems that help operationalize those policies. And then finally, at the sort of bottom and tip of that pyramid, we talk about internal controls. So what are the very practical things we can put in place to help us ensure that we are not vulnerable to fraud? So we'll talk, we talked some about the mission and values, the tone at the top. Let's talk about board-adopted policies. So policies are basically just a written description of the responsibilities, who's accountable for them, whose authority it is to make decisions, and then what actions need to be taken. Now, generally, most policies are set either outlined at the board level, or actually the board can sometimes be more of a working board and be setting lots of specific policies for financial matters, for operational matters, for governance, that sort of thing. But generally, boards sort of set the higher overarching policies, and then we work from there to get more policies that some may actually be written by staff. It's all based on whether the board delegates that responsibility to the executive director and the staff, or if the board is making those decisions itself. I would encourage most boards to take the high-level policy approach, unless they really just don't have staff. And I'll tell you more about my experience on some working boards that existed before organizations ever had staff. And we can adapt some of these ideas to that situation as well. But here are some of the essential policies that really need to be addressed. Obviously, bylaws. Most boards are forced to address the bylaw question when they actually incorporate and form as a nonprofit. Most secretaries of state, attorneys general, and certainly the IRS, when it comes to applications for nonprofit status, are going to require bylaws, articles of incorporation, those sorts of governing documents. But also then other things that have come into play. Some of these came directly out of what people now are familiar with as Sarbanes-Oxley back in 2001 and after, when there was quite a lot of corporate fraud and corporate scandal. There were acts of Congress that actually put in place guidelines for how organizations needed to manage themselves. And though a lot of the things that came out of Sarbanes-Oxley are not actually legal requirements for nonprofits, there are two that are. And one of them is the conflict of interest policy you see here, and then the whistleblower policy. Those two policies are actually legally required as a result of Sarbanes-Oxley. The others are actually, a lot of the other guidance that comes out of Sarbanes-Oxley is actually only a legal requirement of publicly traded corporations. But many nonprofits, and certainly the nonprofit sector, have adopted a lot of those ideas as best practices. So why have financial policies? The biggest reason here is just that it makes clear who's responsible for what, who has authority to decide what, and helps the people who are working in an organization or responsible for the organization's governance, like a board, know what is expected of them. And I don't know about you, but I always respond better when I know what's expected of me, what are people relying on me to produce or decide or actually operationalize. And in many ways, people relax when they know, clearly what is it that I need to do here, and what are people expecting me to do, and when do they expect me to do it. So good financial policies include having those clear responsibilities lined out for everyone. But obviously the policies we're talking about are going to be specifically, at least today, pointed towards managing risk, making sure that we have instituted good sort of risk assessment policies, risk management policies, looking at internal controls, financial oversight, those sorts of things. And it goes all the way down to operations as well. I mean, part of the risk of our operations is that they're so inefficient that we're losing all the money that's been so dearly given to us by our donors and government agency funding sources, and places that if we don't show that we're using it efficiently, we run the risk of losing that funding in the future. So responsibility, clear risk assessment, whose authority it is, all those things are lined out by good financial policies. So we're going to go through some examples that sort of break down, these levels of creating policy and how they ensure that our policies are thorough and cover the whole range of decisions that need to be made. So first there's authority, responsibility, management policies, and guidelines. And we'll talk about each of these levels and how they are different from one another. The first one, authority. Authority is basically who is it in the organization that actually gets to decide certain things. Now, I think many of us would love to think that we had more say in setting our own salaries and benefits, that sort of thing, but we know that there's ultimately someone in the organization or some group, if it's the board itself, or if it's our executive directors, or if we have a direct supervisor, someone who's setting salaries and who has influence over our benefits compensation. So that's obviously just an example of who has authority to decide something. But in organizations, we also have to lay out who is it that can sign contracts and loans, leases, those sorts of things. I've been in more than one organization where there's been some confusion about this matter, and sometimes program staff have sort of unwittingly signed contracts that bind the organization to long-term financial commitments when they really didn't have the authority to do so. So having really clear policies in place and having those policies communicated to folks will help them know where they have authority to make decisions and take action. Now, responsibility, on the other hand, sometimes the responsibility comes, we might not have the authority, but we have been delegated the responsibility to either operationalize a policy or to monitor it and make sure that information is getting back to the folks who are responsible or have the actual authority for the decision or the policy in the first place. So here you see sort of a list of the ways that we exercise responsibility. Now, we'll give an example here pretty soon where we just show how the policy sets the authority, then it breaks down who's responsible for it in these specific areas as far as reporting, completion, compliance, those sorts of things. And then we'll go on and talk a little bit about how we get even more specific now about, all right, we have set the authority, we know who decides the issue. Now we've set responsibility, we know who has to implement it and is responsible for reporting and the compliance pieces. Now let's talk about management policies. This is where we actually, now we're getting down to the point where we start breaking it out into very specific areas. So the management policies that we'll just show brief examples are fixed assets, investments, financial reporting, gift acceptance, these sorts of things that you're all familiar with. Somebody had to decide at some point how we were going to set these policies and who was going to do the research, who was going to come up with the examples. And now we have to make them very specific to each part of our operation. And then finally, the most specific piece we have here are guidelines. So guidelines that we're talking about are right down to the, basically if you had a policies and procedures manual, now we would be talking about procedures, which is, all right, who does what? Who is the actual staff person? Which staff person? Is it our bookkeeper? Is it our accountant? Is it our program manager? Is it our executive director? Who actually does each one of these things? And when they do them, what process do they have to go through? So that's sort of the breakout. On our website, which I highly encourage all of you, especially because I know many of you are spread throughout the country and not specifically here in the Minnesota area, that our website is a great resource for sample policies and procedures, obviously primarily in the finance realm, but that's a fairly broad category. So I would, we'll give the website information again at the end, but www.nonprofitsassistancefund.org, and then going to our resources tab and our resources library is a great place to find examples of a lot of these policies. And here's just the beginning. Now this is just the beginning of a sample policy where again you see sort of the top level, the philosophy, what's behind the policy, why are we even doing it. Then the authority, in this case it's showing that the board of directors is the ultimate responsible for the financial management of all activities. And then it sort of breaks down the authority there. The treasurer gets to act on behalf of the board, those sorts of things. So policies start breaking things down on that level. Then below authority, we'd get to responsibility, and then finally to management guidelines, and then and again, the very bottom level is just the very specific procedures that we follow. So again, we have the board adopted policies. Now we'll talk a little bit about procedures, systems. So where the policies are the statements about where we want to go, how we want to end up here. The procedures are the specific steps and how we get there. So, it's always helpful when we know the directions for how we get from point A to point D and know what the steps are B and C in between so that we can follow those. Just one of the things that you might, and this is an aside, but on the 990, many of you will have noticed that in the last few years, the 990 has changed quite a lot. And there are sort of major sections on governance and policy where we have lots of check boxes about yes or no, do we have these policies, do we follow this procedure? And many of those are not actual legal requirements, but they are best practices that have been identified in the nonprofit sector over the years. And when we come to that level of response to the 990, we just have to know that there are many different ways to satisfy the yes or no, well actually the yes, on those 990 questions. And depending on how we go about that, it may be very different for one organization to the next. Again, it depends a lot on the scale of our organizations, how we're structured. But that's where we would outline is the very way that we do it. The way that's specific to us, the way that fits our organization, we have that in a written policy and procedure manual. We can answer yes in good conscience, even if it's a very different way of getting the the same result as another organization. And when auditors come in, they generally don't look at the specifics. We might have a place or two where we've actually, failed to follow some standard operating procedure for a financial process or something like that. That's a whole different deal. But really, auditors care most is that we set policies that we then follow as an organization. That's where they know that we are responsible to managing our risk and making sure that we are following set procedures, those sorts of things. So having the procedures is most important. The particulars of them can be very different from one organization to the next. Okay, there we are. Now, just as an example, here's a policy at the very highest level. So mileage to be reimbursed at the current IRS rate. So there's a policy. Generally, a policy that specific is probably not set by the board. That's probably a management, staff management role. But once we have the policy in place, then the next piece below it is what is the procedure? Here's some examples. For this example, now our procedure says that all non-local travel be approved in advance by employee's manager. Next piece, staff shall submit mileage reimbursement requests by the 25th of each month. So now the staff knows exactly what to do in order to enact this policy that mileage is reimbursed at the current IRS rate. Here's another example. Donated stock sold immediately. That's a common practice for a lot of nonprofits because we tend not to want to accept the risk of holding stock and watching it fluctuate in value up and down unless we have a large stock portfolio that's professionally managed. This is a very common policy. So what does that mean exactly? Well, here's the procedure that goes with this. This just says that stock donations shall be processed through, and it gives the organization's account. And this is no endorsement of Charles Schwab. It's just to give you a very specific example of how this particular policy is actually operationalized. So once we have policies in place that outline the authority, who's responsible, actual guidelines, and then the procedures for them, how do we monitor them and how do we make sure that those policies are actually affecting our organization in a positive way? Well, that's where we come to setting up internal controls. Now, this is sometimes a misunderstood concept, but really internal controls are not just about a big book of policies and very particular ways of doing things. Internal controls, again, starts with that tone at the top and really is about making sure that our organizations are not leaving any one process or any one procedure or any one financial management piece to just one person. It's about getting a good oversight by a number of different people, making sure that what we do is transparent. And here, just some of the places that internal controls are really needed. Of course, cash transactions is the place we most get excited, but of course there's very little cash in most nonprofits these days. Churches might be an exception. There may be some places who have cash transactions going on with clients who are coming in for particular kinds of retail transactions. I don't mean retail in the sales sense, but just that where they are actually coming in for services and paying in cash. Could be even mental health or behavioral health, co-pays, things like that, where there might be cash involved. And certainly that gets people's attention, and is one place you'd want solid internal controls in place. But really, it could be any transaction cycle. And when I talk about a transaction cycle, I'm talking about from basically the cycle from where receipt of some funds, either cash, check, electronically, somehow comes into the organization, how the organization deposits, tracks, reports on that information, how we reconcile that information, and then, again, a disbursements process if we're actually paying that money out to vendors, to clients in the form of support or grants to other organizations, that sort of thing. So that's a transaction cycle. So here are just a list of all the places that are likely to be places you want good internal controls in place. Segregation of duties is actually one of the most common ways that we can address this whole issue of internal control. And one of the things I'll say just philosophically about internal control is that it's not just about setting things up so that the organization is safe from the misbehavior of an employee, and certainly not just to protect us from the misbehavior of a finance employee, an accountant, or a bookkeeper. That's maybe a little too narrow view of what might be a potential risk in an organization. Instead, segregation of duty, really, as a finance person myself and as a long time worker in the nonprofit world, I want segregation of duties just to make sure that I'm not the only one who's involved in some transaction. I want to make sure that other people have seen my work, that I'm getting it reviewed. One, it's always useful to have other people see my work so they can catch the little mistakes. It's a lot easier to change things and adjust things at the time they happen than to try to figure out 6 months later when we're preparing for an audit why this number is what it is and we have no idea of knowing what happened or what someone was thinking at the time. So I always appreciate having other people see what I do. Now, we're not a large organization. Well, compared to some, you might think we are, but we have 11 staff people and 2 people that actually work at least partly directly in the financial realm. Now, 2 people is not really enough to divide up even all the things that are on this list that you see here. So we have to figure out other ways to break up that chain. That's the way we speak of this. We have a transaction cycle here that goes, in this case, going from preparing an invoice and sending it out to somebody to be paid. That's either for a pledge or a donation or something like that, or could even be a billing for a service, all the way to actually putting that money in the bank, moving through the bank statements, all the way to the financial reports at the end. That cycle, if I can get that cycle broken up so that there are more than just my eyes on it, certainly more than my eyes and the accountant that I supervise is on it, if we can get that broken up so that other people in the organization see it, all the better. So if I took this particular example, I would tell you that our accountant generally prepares invoices for billings, for consulting, for training, those sorts of things, the places where we actually have earned income. So our accountant may send that out. Now, we have somebody else in our office, not even a finance person. It's actually our communications coordinator who receives and opens the mail. And we do that just as a way to separate out those duties a little bit. So especially for small nonprofits, I really encourage you to look around to see who might be able to be part of this chain. It might not be the people you would traditionally think. Small organizations may have to rely on volunteers, either board members or office volunteers. You can rely on program staff like we do. So once the mail comes in, the communications coordinator makes a receipt of it in a journal, a ledger, so that we know that it's come in. Then it's handed off to the accountant who actually prepares the bank deposits. Those deposits are then forwarded to me and actually to our entire staff in a daily report that shows the daily receipts. So especially for us, because we're a loan program, it helps our loan officers to know that certain clients have made loan payments that day. So folks have seen the deposit made. I make a lot of the journal entries, those sorts of things. And then when the bank statements come in, those are actually initialed and then reviewed and reconciled physically by me, but then after I have actually reconciled the bank statement, our executive director reviews the bank statement, all the month's journal entries, all the bank deposits, those things, so that our executive director gets to see all of that information. Some of it in summary form, some of it in detail. So now we have 4 different people so far that have broken up this cycle. And then preparing the financial reports comes back to me. So all that information has come in, different people have seen it along the way, and it really shows to the auditors that we've done a good job of breaking up that stream. Now that may seem extreme, that an organization with only 11 staff has 4 different people involved in this cycle, and you may think, okay, I only have 1 executive director and a board to use, but I think you can get creative about ways this could be dispersed among all those folks. I think especially the bank statements. Many of you already know you can always have the bank statements sent to an interested party, so they don't even have to come to your office. They could, or they can go both to your office and to your board treasurer, something like that, so that there's always some oversight and a second set of eyes on almost everything that happens. Now, for your internal use, we want to, suggest that you pick up this segregations of duties worksheet that we actually have on our website, and it's a great way for you to go around and sort of do an inventory of, or an assessment of who all in your organization is involved and responsible for each of these different duties. And it helps you know, one, if one person has too much authority, or two, places where you might be able to divide out those tasks and get other people involved. So if you look down that list, approve and sign contracts, send invoices, go all the way down to the bottom, prepare payroll checks, those sorts of things. One aside about payroll, and I just had a technical assistance client in my office yesterday. We spent over an hour trying to track down some accounting errors in their payroll over the last while. And unfortunately, this organization has a volunteer bookkeeper who is not really familiar with doing payroll. It's a very small organization. Payroll is sort of in disarray, not confident that the right amounts of tax liabilities have been paid to the proper agencies, those sorts of things. I will say about payroll that even for very small organizations, 1 or 2 employees, and actually primarily for organizations that are below 10 to 15 employees, we highly recommend that you outsource your payroll to a professional payroll service or a bookkeeper or accountant in your area that actually does those things. It's a very small investment to take one of the highest liability areas out of your office and get a whole degree of separation there that allows you some internal control, and frankly just doesn't demand the capacity of your staff to know payroll law, wage and hour laws, tax liabilities, and it's always the most complicated piece of accounting for very small nonprofits. So that's an aside, a little bit of a soapbox, but you can ask me more questions about that later. So back a little bit to the big picture on this whole topic. If we look at the financial responsibilities of the board, so we just looked at staff. You had that list of sort of breaking things out in a very specific way for internal controls and segregating duties. If we go, take one step back and look at the big picture now as far as who's responsible for what in an organization financially, I would say that at its best, and sort of, if you've heard the term sort of highest and best use of someone's time and talents, ideally you're working towards having your board be involved at the strategic level and the visionary level and the governance level to move your organizations forward. Now, I was on the board of the Montana Nonprofit Association when I lived out in Helena, Montana. I was on that board at its beginning, before we had staff, before we even had funding. So I know what a working board is all about. There's no staff to delegate anything to. We had to be both governance, policy, vision, and we had to do the work. Of course, I was a CPA, so I ended up spending my 2 years as treasurer, because you always have to do that if you have a CPA behind your name. But I spent that time as treasurer doing things that eventually we would then pass on to paid employees. But ideally, we're moving our boards always into this in the direction of being more at the strategic level, because our boards, that talent is where we're going to sort of see where we're going next and how we can best accomplish our mission. And you always want them to work at their highest level possible. So they're the ones who are setting the policies that we see here. And again, we've been through that sort of hierarchy of authority and responsibility, and then guidelines and actual procedures. So the board would be hopefully, ideally, eventually, working to that point where they're setting things at this much higher level. Now, the staff, on the other hand, are going to be the folks who are the bridge between what the board is setting as its plans and goals, and using its policies and guidance. The staff will be the folks who are actually operationalizing that. Now, it's a big task to ask when you only have one person on staff, just one executive director. But basically, that executive director then, ideally, at some point, maybe they'll be able to hire their first employee or their first and second and move on from there. And some of you may already be at the point where you have very complex organizational charts where you have many departments and many employees. But basically, however you have it structured, the staff is then responsible for bridging the gap between the board's direction and high-level priorities, and then actually operationalizing them. So preparing and planning, and all the way down to reporting back. So it goes the whole cycle where we actually make the mission happen, and how do we do that with our programs and our services. But then we also have to bring all the board's policies into the way we do that work. We have to follow those policies, report back to the board that we are, show in some way that we are complying, and then report back in ways to show that we're monitoring our activity, we have good internal controls in place, that sort of thing. So here's just a visual of that same breakout where we have the board at the mission and strategy level, and then the staff at the planning and implementation level. And just a way to, this is probably common sense to most of you, but I think especially for smaller organizations, it's realizing that there's a natural progression in the growth of nonprofits that's going to keep pushing us in this direction, where the board takes on a higher level role the longer we are in existence. And one of the very practical ways in the financial realm where the board is setting priorities is the budget and oversight of the budget. Obviously, just a few comments about that process. For those of you who are responsible in the budgeting process, seeing this as just a yearly task that we just sort of make up numbers for the next year, put together some hopes for the future, have our aspirations down on paper, that's one way of looking at it. But I actually would encourage you to see it as a more formal way of putting our mission into a different language. We take our mission and actually put it into financial terms, and those numbers, those dollars and cents that we see, shouldn't be seen as so esoteric or so far removed. They're really just another language that expresses our priority and shows where we're going to be putting our time and attention in the next year to accomplish our mission. When you see it that way, it becomes more, oh, okay, this is just one more place where I get to demonstrate what we're all about. How can I take the strategic plan that our board worked so hard on over the last 3 years, how can we put that into something that's very tangible and practical? Well, here's our budget, and here's how that goes. So the process for that is just, one useful thing is to figure out where the board meeting is that you actually, or when the board meeting is that you actually have to have the budget decided on, because it's always best to have the budget in place before the beginning of the fiscal year. It's certainly best practice and sort of looked on as irresponsible not to have the budget in place, and then back up from there. And just set the steps and process to allow whoever's input you're going to gather to give time for that input to be brought into the process, to do the number crunching, the revising, all the practical pieces of it, and to actually bring it to the board before that happens. So the board's oversight of the budget is a very important role because it's one of the most tangible places for them to show their influence in an organization's mission. Here's just a brief outline of sort of the roles that the board can play. And really, we're talking about board or committee roles as the darker boxes here. The lighter boxes, with no background in them, those are the roles that are most often assigned to staff. And again, this depends on the scale of your organization, the size of your organization. But really, the board is the place where they're going to be agreeing on the goals. They've probably done this already when they set the mission of the organization at its very inception. They do it every year in annual reports and goal setting, if you have annual work plans or annual goal setting by the board, certainly in a strategic plan if that's a 5 or 6 year document. They have to know what the current financial status is to know what they have to work with, but also sort of the trend and what's to be expected. And just a little aside as far as financial management goes, we've been emphasizing more and more sort of less, not ignoring budgets and not ignoring our financial statements where we look back over what just happened in the last year. Don't ignore those things, but really the more important work for organizations is to forecast what the financial situation is going to be in the next year. And we have a whole set of resources and webinars and trainings that we do to try to help organizations get beyond just sort of coming up with plug numbers and sort of aspirational hopes for revenue, that sort of thing. Instead, we've helped them look at, okay, if we're forecasting into the future, what can we actually rely on? What funding sources can we rely on? What expenses do we have already locked in with our current staff structure? And we won't build a budget next year just based on the fact that we hope we're going to raise more money. We need firm commitments, or if we decide we really are going to raise our individual contributions from $50,000 to $60,000 next year, do we have a plan, a legitimate plan that gets us from 50 to 60? What are the economic trends going on? Do we actually have staff capacity to raise that extra $10,000? We just always are trying to help people sort of shore up their processes when it comes to budgeting and forecasting so that we're doing it in a responsible way. So obviously the board's role there is to understand the current financial status, but then agree on the budget approach. Now we're talking before the budget's actually been developed. So we give the staff, as a board, we would give the staff the responsibility for generating the budget and sort of let them know how we expect that to be done. It could be just completely delegated to the executive director who works with the staff to do that. The board may sort of make guidelines or insist that the executive director include other staff people in that process. The board may be very active. The treasurer of the board, especially in smaller organizations, may be the one who actually has to do that budgeting. So you just agree on the approach. Then whoever is responsible for it goes out, drafts the expense side of it, the income side of it, and bring it back to the board for review and finally approval. So now just to talk a little bit about restricted funds. And again, we're in the context here of, you know, what makes for a financially healthy nonprofits. Now restricted funds, I'll actually say it belongs here in this context, even though we're talking overall about sort of transparency, financial reporting, good policy making. Talking about restricted funds is another one of those areas where competency and the ability of organizations to manage in this area goes a long way to their financial health. This may be sort of catch-up, or not catch-up, or review for many of you. I hope that it is. And some of you may be new to your roles, either as a nonprofit board member or as a staff member. And it doesn't matter if you're on the program side or finance side, understanding how money that comes into the organization might be restricted and what that means will give you some sense of how it has to be managed and overseen. So the thing that makes us unique as nonprofits is that the folks who donate to us provide information or provide money that comes in. They can actually put a restriction on its use, either by time. They can say that here's some money now that we would like you to use next year for this project, or they can put a restriction on that, the use of that money by its actual purpose, and say here's some money for your program that's doing training for parents in a particular area or a particular school system or something like that, where the donor has actually restricted the use of that money to a particular project. Now often we actually go out and raise money for a particular project so that we are inviting that restriction from the donor. If we put out a proposal that says we're going to do a specific thing and the donor actually funds that proposal, we have, in a sense, written the restriction. The donor could come to us in a more general way and actually provide for us money that they restrict, and if we accept it, we accept that restriction as well. Obviously, the most useful money and more flexible money for nonprofits is the unrestricted money, and that can be in the form of a general operating grant that a foundation might give us. It could be in the form, any earned revenues that we have are generally unrestricted, but they are generally also paying for things that we have already provided. So you might have government grants that are on a fee-for-service basis. So you go out and do the work and then bill the government agency. They pay you for that money. Since you have already done the work, by definition, when they pay you the money, that money is unrestricted. Of course, it's going to pay for things you've already, and expenses you've already incurred, but it is unrestricted. Temporarily restricted money, again, at the time that it is donated to us, we have to book it in our financial statements and reporting systems and accounting systems as temporarily restricted. And we will talk here in just a couple minutes about very specific examples then of what we do to release that money from the restrictions. I'll just say a little bit about permanently restricted grants. Less common these days. Endowments have not been quite the rage that they were 15 years ago, and for a good reason, partly. For a permanently restricted fund is generally an endowment. Not always. Sometimes money can be restricted to the purchase of a building or something that's a long-term asset, and so it would be permanently restricted in that way. But permanent restrictions are often come in the form of endowments where a donor could be a planned gift at the end of someone's life, could be a capital campaign that's actually specifically set out to raise an endowment, where the donor gives you an amount. The principal amount of which is permanently restricted, meaning we are not to spend down that amount. And just for example, say if they gave you a $100,000 endowment grant that was permanently restricted. The $100,000 they gave you is the idea is that you would invest that money in some prudent way that would provide a return, and you would be able to use the return for some purpose, either unrestricted or the return itself could be temporarily restricted to some use that the donor and you agreed upon. Now, the $100,000 is to be protected and remain intact, and just the earnings are what you get to use. So that's what the permanent restriction is on the corpus or the body of that money, the principal amount. It's more rare these days, and we actually counsel nonprofits all the time not to start endowment funds unless there is a large enough potential for that endowment to get to the point where it actually would have an effect on your day-to-day operations. And if you think about it at current day interest rates and the volatility of the market, it takes quite a lot of endowed resources to make any kind of an impact on our annual budgets. It takes literally millions of dollars to start bringing in enough money to make a permanently restricted endowment a useful thing. So a couple things about managing restricted funds. Just to look at two different sides of it. There's the management of them. There's the accounting for them. As far as managing restricted funds, it's really about budgeting them as well. So in our budget, we always have a line item for release from restrictions, and that's basically the term that when money comes in at some point and it has a restriction on it, we book it as temporary restriction. When we fulfill that restriction, either by, again, time, because we've used it in the time period that the donor required, or we've used it to accomplish the purpose that the donor gave us the money for, we release it from restrictions. When we do that, that's when the money hits our income statement, our statement of activities on the unrestricted column. And that's where most of us are used to seeing our budgets, our financial statements are all about the unrestricted column. So as far as learning to manage that, we should budget for that. We should have a line that is released from restrictions on our chart of accounts, and we should know basically in the next coming year when we're making a budget how much is going to be released there. And we know that generally from the timing of the grants, of which grants we're going to apply for, which ones are going to be temporarily restricted, all of that. Now the accounting side of that is how do we account for it, how do we set up our financial systems. I would always recommend that the first and foremost place to do that is actually build the accounting system so that it tracks unrestricted and temporarily restricted and permanently restricted funds in a useful way. Some people are sort of relegated to using Excel if their accounting system isn't up for the task. And of course, Excel is one way to do that, though frankly, I'm sort of lazy. So I always want my accounting, I'd rather put the work up front into my accounting system, and I would want that to do the tracking of my temporarily restricted funds so that when I release them, I can count on my accounting system to have them accurately recorded, so I can just run reports and I can find and follow that temporarily restricted money and know when it's been released from restriction. Here's a quick example of managing temporarily restricted funds and how to record them. So if we had a grant that we received in December of year one, we'll just say year one and year two here to start. If we had a grant that we received in December of year one for $15,000 that's going to support an annual summer festival in the following year, whether we receive that money in cash or not, we still are going to, if we have the actual letter, the commitment from the funder that they are going to give us $15,000 for this particular event, we're going to record that as income. Now, we're going to probably have a column or a special way to separate that income from other sources because it's temporarily restricted, but we're going to record it as income in December. So in year one, we are going to record $15,000, even though we haven't used it for its required purpose, even though we haven't used it at the time that it's set aside to be used. Now, the expenses for that festival that we just received the money for aren't going to happen until June of the following year. So we won't record the release from restrictions for that $15,000 until we've actually spent that money, which is we're going to be spending the money in June. Now, you notice June is the month before the event in July. In this case, as long as we have spent the money, we've actually fulfilled the purpose of the money, we can release it in June even though the event is in July. And I will show you that sort of what that looks like in the financial statement. So here's, our year one is 2008. I'm sorry we haven't updated that a little better, but for us, year one is 2008. And you see where we show here, and I'm going to see if my pointer comes up. You can see that. If you can't, I'm looking at the column under temporarily restricted, where there's $15,000. That's the $15,000 that we received as a, could either have been a pledge or cash, a check. We're going to show that amount in the temporarily restricted column in 2008. Now, we haven't spent that money yet. It is temporarily restricted. You'll notice it's not over here where, and this is unrestricted column is where we normally see our financial statements, unless we're doing good breakouts here. Now that we have it recorded in the year that it was received, let's look ahead here and see what happens in 2009, which is our year two. So now that the restrictions are met, the temp restricted funds are transferred into that unrestricted category. And you'll see here this line 6 here that we have boxed off is a chart of accounts line item that some of you may be using now and some of you may not have used yet. And this is the place where we would actually release the restriction. So the way that shows up is you see that we have released the $15,000. So we actually have a negative entry here. As you're reading a financial statement, you'll see the temporarily restricted money is decreased by $15,000 here. Just as a note, the $40,000 that you're seeing up here is unrelated. That's $40,000 in restricted money that came in 2009. Right now, we're only showing what's happening to the $15,000 that came in 2008. And even though this is a 2009 financial statement, this activity is happening, 2009 financial statement. This money came in 2008, but its activity is happening in 2009. So we're releasing it from restriction by taking it out of temporary restriction and adding it into the unrestricted category. So that's just to help you if you're unfamiliar with reading financial statements, nonprofit financial statements especially. That'll show you where you're going to find the temp restricted activity on the income statement or statement of activities, whichever you're calling it for your organization. Could be calling it profit and loss. In any of those accounting systems, it doesn't matter if you're on QuickBooks or something high-end like Financial Edge. All of them have the ability to have this line item. You just have to add it. And to manage, in this regard here, with columns. These can be classes in QuickBooks. They can be account segments in Financial Edge or Sage Fund Accounting, anything like that. So it's not which accounting system you have. It's just how you're using it. Now this also shows you when you're looking at the full picture here of the effect of that $15,000 release. Up here again you see this is what we saw on the previous slide, and here's where we released that $15,000. Now you see that we have net figures at the bottom. That $15,000 contributed to the overall total support for the organization, and then here are the total expenses, and we had a net surplus or deficit, in this case a surplus of $1,300 for the year in the unrestricted category. And again, that's all that most boards and most staff are used to seeing. But to get the fuller picture, and then we see over here in the temp restricted column that the effect of that $15,000, we received $40,000 in new restricted money this year. We released $15,000 from last year. So the net gain in temporarily restricted money for the year is $25,000. And that amount also shows on your bottom line. We're seeing it here on this is a cutout to show some detail, but that's really the bottom line. Now just to let you know that balance sheets, which we also think are one of the most important financial tools we have, are the place where you're going to see as well how that unrestricted money, temporarily restricted, and permanently restricted money is being shown on the balance sheet. Now this is where you know what resources you have for the future. So we want to see how that impacted us and how it changed our net assets, our total assets, and what we have remaining to go forward into the next year. Now again, here you see the effect of that here's the $25,000 increase in net assets and temporarily restricted for the year. Here's that $1,300 surplus in unrestricted net assets. And you'll see those are just showing up as a change in net assets on the balance sheet. So there's that activity. Now, these numbers up here, even though they're in the temporary restricted column, and this is coincidentally the same as the number you saw on the other slide, these really have nothing to do with the activity for the year. That's just what's in the cash balance for temporarily restricted. Really, the only way we're tying the balance sheet to the income statement we just saw is down here where we're seeing the change in net assets, both unrestricted and temp restricted. So the last topic I want to address, and then we'll open it up for questions, is just this whole idea of finding a way to use external review to help us manage our risk as an organization. Now, obviously, the place we think of this most often are audits. Everyone has heard of audits. Some people dread audits. Part of it is, the thing that I want to say about audits is it's not the only way to provide effective external review for our organizations, and certainly for some small organizations, it's not even recommended just because of the cost and time involvement that it would take to do that. Many of us know that in whatever state we are in, there may be thresholds that are different from state to state that require us to get audited at certain points. In Minnesota, the threshold is $750,000 of gross revenue. Any organization that meets that threshold is required to have an audit, and that's a requirement of Minnesota regulatory bodies, Attorney General's office. Federal grant awards that involve more than $500,000 of expenditure, different than revenue, expenditure, are required to have a single audit at this point. That number may be changing. You may have heard some buzz about that. There are recommendations coming out of the Office of Management and Budget that figure be raised to $750,000, but that's still just in the review stage, review and public comment stage. So that change has not been made yet. So the threshold still is $500,000 of federal expenditure. Just as an example, we just did some work with a group in Pennsylvania, and I learned through that process that their revenue threshold for an audit is only $300,000. So it's just an important thing to be familiar in your state is what level, what financial thresholds are there, either revenue or expenses, because sometimes it's one or the other or both. Sometimes it's actually an asset threshold. If you have a certain number of gross assets, that might trigger the need for an audit. Just be aware of those numbers so that you know at some point you might actually have a regulatory or compliance issue for having an audit prepared. Now, the other reason we might have an audit is that we might have a funder. No matter what size we are, we may have certain funders that require audits. And at that point, if you aren't required to have an audit by a regulatory agency, I would encourage you to negotiate with your funder that if they require the audit, they may be the only organization requiring it of you, and would they be willing to pay for it? It's always good to ask. But beyond just the idea of the audit, I want to make sure that you realize that there are different services that a CPA or a CPA firm can provide short of an audit. The one that's sort of the least level of oversight and review on their part is a compilation, where technically really all they do is come in and compile information that you've provided. You have your set of books, you have your bookkeeper or someone on staff who's doing that. You basically turn it over to an accountant, and they put it together so that the form of the reports is GAAP compliant, and GAAP stands for Generally Accepted Accounting Principles. So they would really just put your information that you provided into a form that to the public would look like a standard GAAP financial report. They don't provide any testing, any oversight of your internal controls, any review of anything you're doing. There's nothing at that level. It's not an attestation service, and attestation means that they aren't attesting to the accuracy of your information in any way. And they will say that very clearly in the front of any compilation that they do. And often they may also say, there may be a line on the compilation they do that says for management use only, which means you are not even at that point to present it to the public as a financial document. Now the next level above that is a review, and I'll just describe it here briefly, describe an audit, and then come back to the review. But the review is basically an intermediary step where auditors, an accountant firm might come in and provide a certain level of oversight and review of your books. It's not an audit. They don't do any testing. They don't do transaction by transaction testing of your organization's financial systems. All they do really is look at a very high level at your finances. They do what are called analytical procedures, where they're going to take your finances this year, compare them to last year, maybe ask many questions about certain ratios on the balance sheet or certain trends or changes in account line items to see if anything is, if there are any unusual happenings in the organization. They do a lot of inquiry, meaning they're going to ask questions of the board and the staff and the executive director to try to basically find out if they think there's any cause for concern. That's a very high level look at your books, and it's not in a sense a mini audit. It's not related to an audit in that sense at all. So I sort of warn people away from doing a review thinking, oh, well, at least we've got a little bit of oversight. Really, you don't, not as much as you may think, and it is still an expensive proposition. Now, the full audit itself, obviously, is the place where CPAs are involved to a higher level degree and actually do test your accounting systems and books, and even these days do a review of your internal controls. One thing just to say about hiring an auditor, this is generally a board of directors' responsibility. It's just a piece of governance where the board should be involved. And generally this can be delegated. It doesn't have to be, but it can often be delegated to an audit or finance committee. And the requirements that are in the Sarbanes-Oxley Act that I mentioned earlier, and again, these are not legally binding for nonprofits, but they are considered a best practice, is that they talk about that audit committee or finance committee, whoever it is that's responsible for this, for hiring the auditors, that they are financially and otherwise independent board members, meaning that they don't have a financial stake or some other sort of business proposition where they are involved in this nonprofit that they could benefit personally. It doesn't mean, when it says independent, it doesn't mean they have to be separate from the board. That's not what independence means. It just means that they don't have a financial tie to the organization in a way that they would be wanting to influence that the audit came out one way or another. Now, you also may have heard in the talks about the Sarbanes-Oxley Act that selecting an audit firm and changing an audit firm is somehow a requirement every 3 or every 5 years. That is not a legal requirement for nonprofits. It may be considered a best practice, but there are certain, you need to know there are certain impacts for changing auditors from, certainly and very often, is that the auditors you do have will be able to go more and more in depth over time as they get to learn your organization. Now, there may be some advantage for changing audit partners from, for example, after 3 or 4 or 5 years, to actually switch up within the same firm even to a different audit partner, just because you get a new set of eyes. It helps get a little bit fresher look at what your organization is up to. Each auditor is a human being, so they have strengths and weaknesses and different things that they sort of pet issues they look to. But it's short of actually having to go out and hire a new audit firm every now and then, just switching up the partner within that same audit firm might be helpful. Now, the other advantage of bidding out your audit process every now and then, every 3 to 5 years, if you don't mind that bit of change and the sort of startup that goes into that, is it may keep all the auditors in play a little more honest about their fees. I don't mind being upfront with my auditors that I want to make sure that the fee they're charging us is still in line with the market. So just a few things about an audit itself. Just so you know what an audit provides, besides the testing and all the field work that you may be familiar with when auditors come in and they ask to see certain transactions and they go over your reports and they interview board members and all the pieces they do, really what they end up providing you at the end is basically what you're looking for. Sounds like, it doesn't really sound that good, but it is good. That's an unqualified opinion. That is actually the highest level of opinion you can get from an auditor. And that unqualified opinion basically says that there's nothing that they found that causes them to think that your financial statements aren't presented fairly, that they're not presenting to the public the true position you have as an organization financially. Now, the things they have to include are obviously the opinion letter where they state that, Now, a qualification, which would be a bad thing, is if they say that your statements reflect in all material aspects your organization except for, and they might go on to say except for in the way that you've treated depreciation, or except for the fact that a certain revenue item isn't recorded properly. Those would be the kinds of things you would not like to see in your audit statement. And of course, an unsatisfactory audit statement would be one where they would say straight out that your organization's financial statements do not represent fairly your financial position, and they might go on to say some material weaknesses or material flaws in those statements that would point to the reasons why this organization basically failed its audit. Now, hopefully you don't get to that point and would have taken corrective measures before you got there. And that's one thing I will say about auditors and any accountants really that you bring in from the outside is please see them as assets and as allies. Auditors don't come in wanting to fail your organization. They are actually a great resource in between audits to help you sort of improve your accounting practices and procedures. They're great for getting advice about how to institute better internal controls. And it really helps to be working with them through the year so you're not surprised by those things at the end of the year, and you don't have to have them present either an unfavorable audit or even a management letter, which is a communication that they have to provide to your board and management, where it would lay out some weaknesses or things that needed to be corrected. You can avoid all that if you just stay in touch with your auditors all along. But other pieces of that audit report that they're going to put out for you are things like the statement of financial position, the statement of activity, statement of cash flows, statement of functional expenses, things that you're familiar with seeing but in a very particular form, which is GAAP, or generally accepted accounting principles. The statement of functional expenses, if you're not familiar with that particular statement, that's where you see our program expenses and admin expenses and fundraising expenses broken out so that you can see all three of those things. That's what the statement of functional expenses is. Just one last piece here for all of you to think about. There are alternatives to an audit. You know, if your organization isn't required to do an audit either by the thresholds it meets financially or by some outside organization that's requiring it, think of other ways that if your board especially wants to have some outside view of your organization without the extreme expense of an audit, then there's other ways to do that. You can hire in an accountant who in their engagement with you will be very clear that they are not auditing you in any way. But you might come in as a management consultant, they might come in as a management consultant, and actually make suggestions for you about how you improve internal controls, how you set up systems and financial management practices that are going to put you in good order. It doesn't even have to be an accountant. If you look at some of the next couple of ideas, if you know of other nonprofits in your area who are financially sound, well-respected, you know they have a great CFO or finance director, invite them. See if they wouldn't be willing to come in either on a volunteer or even offer to pay them some fee to have them come in and sort of do a systems review for you, to come in and look at how your organization is set up and give advice and ideas. You can even go to your own board members. If you have on your board any accountants or folks who have financial acumen that would work at a level that they could come in and provide ideas, invite them to come in and spend some time over looking over your financial systems and policies, help them, give them information that would help them assess your internal controls, those sorts of things. And then finally, of course, there's always the resources you can find out on the web, ours being an example, our website, place where you can find self-assessment tools, things that will help you sort of go through the process of looking at your own organization and seeing where you stand. We do have this financial self-assessment on our website. It's just one place where you can sort of go through and do a quick inventory of where you stand with some of these things. It just gives you more ideas about where you can focus your efforts as a board or staff on improving things financially. So thank you. That is the end of the presentation, and I know we have about 15 minutes left, I think, for questions and answers. I'll turn it over to Gretchen and see where we stand.
Great. Thanks, Kurt. We have no questions at this time, so I'm going to remind people to please type them in. But thank you, Kurt. I think you did an excellent job presenting this information for both the larger and smaller parent centers that we have. We did receive one comment from someone just echoing your comments about auditors and how great they can be to work with throughout the year and not just at the time of your audit.
Yeah.
I'm also going to remind everyone that we are recording this webinar, so if there are other people at your office that you think could benefit from listening to it, we will send out the link once it's on the Parent Center Network website. Otherwise, I'll just pause a few seconds here to let people type in any questions if they have them. Receiving some compliments on your presentation, so I think it was very clear and people followed all your presentation very well, so that's looking good.
Thank you.
I'll also remind everyone that the next webinar, kind of a part 2 on this presentation. Kurt, I don't know if maybe if you want to speak a little bit about what will be covered in that next presentation.
I would be glad to. I'm going to pull up the outline just so I get it accurate. So this will be more of the pause while we wait and see if anyone still has a question.
Yeah, it gives people some time to think of their questions.
Yeah, the next session is actually financial planning for sustainable nonprofits. And that's where we're actually going to look at very specific analytical tools, some very practical conversations about decision making and sustainability, and then do a little bit of talking about scenario planning, budgeting, case examples about looking into the future. Hopefully more practical than looking into a crystal ball.
All right, thank you very much, Kurt. It looks like we do not have any questions coming in, just lots of thank yous for the great and helpful presentation. And if people think of any follow-up questions later, they can certainly include those in the evaluation or email those to Debbie or myself at the National Center, and we'll potentially we can include those in a brief follow-up of the next one if we get any questions. Otherwise, Kurt, I want to thank you again for joining us today, and we look forward to talking to you in a few weeks.
Great. Thank you. Thank you, everyone, and looking forward to it.
All right. Thanks. Have a good afternoon, everyone.
Bye.